being taxed at ordinary income, that's a big deal when you can have the buffer ETF that can deliver the same risk profile to you, be tied to the upside of the equity market, and then come away with long-term capital gains, and also put yourself in control of when you're actually paying that tax bill.
Yeah.
It's a very big advantage.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Appreciate you coming on, first off. Why don't you just help me understand really quick, Chief Investment Strategist at Innovator ETFs. What's your sort of industry background? What have you kind of done throughout your career? And what are you doing really at Innovator right now?
Yep. So I started out my career actually on the advisory side. I worked for a wealth management team in the Chicagoland area as just doing whatever they needed, really, analyst within JP Morgan. Transitioned from there and went to a company called PowerShares. ETFs was bought up by Invesco. They're now the fourth largest provider of ETFs in the world. But for them, had several different roles, had the opportunity to help them build out their capital markets offering, as well as fixed income strategies for the ETF group. From there, went to Northern Trust, spent several years at Northern Trust, was a senior investment strategist there, really working with they have about 300 different portfolio managers in-house. They do just like the ultra high net worth individuals. And really what I was doing there was just helping them put together their portfolios for their clients, giving them talking points for their meetings, why we put things in the portfolio, why we took things out, different things like that. So, and then from there, back in 2021, I came over to Innovator.
Okay. And what are you doing at Innovator now?
So I'm the chief investment strategist. Wear a number of different hats. Head up our model portfolio business. Also do all of our market commentary, views on what we think is happening, what's going on, where are we heading, and then also just helping all the advisors that we work with across the country build out their portfolios using different buffered ETFs.
Okay, and that's really your guys' bread and butter is like the buffered ETF, right?
That's correct.
And so I think of buffered ETFs. When I think of buffered ETFs, I think of the fixed index annuity killer. That's what I think. In so many regard where annuities have been abused in the past, I think there's an opportunity for buffered ETFs to accomplish what some of those products that were designed to be sort of a lower risk alternative for people to still get some kind of return, especially a return kind of tied to the markets. And buffered ETFs can deliver on that in my opinion, an easier way that can become more tax advantageous. It's more transparent. It seems to, for a number of reasons, more liquidity, and a little bit more performance, right? A little bit more of the upside capture.
That's exactly right.
Tim, maybe recap really quick. How does what is a buffered ETF in its sort of simplest explanation?
Yeah, at a very basic level, a buffer ETF is a strategy that's going to give you a known level of downside protection over a specific outcome period and a known level of upside participation. Meaning that, as an example, if I have a 15% buffer over a 1-year outcome period, I know that if the market goes down 0 to 15%, I'm going to be fully protected from those losses. And then I'm going to have upside exposure up to whatever the stated cap is, which right now those are right around 12%. So it's really a way to narrow the range of potential outcomes and really hone in on the precision that the wrapper and the structure offers.
Yeah, not something that everyone needs, but at a certain time and place, right? There becomes an interesting use case of trying to define the outcomes more. When I think of it like comparing to an index universal life insurance policy or a fixed index annuity type opportunity, the downside protection, those are oftentimes sold at, like, oh, you can't lose money. And you can get, this participation of the market. If the stock market goes up, 8%, you can get 8%. But if it goes up, 10, but your cap's 8, you still get 8. But, that's okay because you can never lose money. And that's sort of what the broad sales pitch is on that. And there's nothing wrong with those products inherently. But I do think the misuse is where so many people just have, they don't understand the other nuances that come along with those contracts, right? The surrender period, the cancellation charges. But primarily, I think one of the things that's largely misunderstood is the ability for the insurance company to determine what the cap and downside protection is, which is normally 0. And buffered ETFs, correct me if I'm wrong here, but there are buffered ETFs that offer that 100% downside protection. Now that doesn't mean that intra-year within that outcome period, the what's called the NAV, or the sort of what the price you see of the fund, can't go down intra-year while it's in that period. It means by the time the period's over, it would come back to break even. Is sort of how it works, right?
Yeah, that's right. And I think to your point, why you call the buffered ETF the annuity killer, is a lot of those and a lot of those what you consider to be gimmicks or inefficiencies of the insurance type wrapper,
Mm-hmm.
the buffer ETF eliminates. And that's actually, Brendan, how our firm was formed. One of our co-founders had his financial advisor that came to him and was presenting an indexed annuity, and he really liked the payoff. He liked the downside protection that the strategy offered, but he didn't like the wrapper that it came in. To your point, the surrender charges, the lockups, really the lack of transparency in, am I getting the highest upside possible right now, or are there some type of marketing and gimmicks that are taking place? And that was where he came up with the idea of, hey, what if we tried to launch this type of payoff that investors love in a more efficient wrapper? Let's bring the cost down. Let's make it more tax efficient. Let's eliminate a lot of those inefficiencies in the insurance wrapper. And that's really how Innovator and the whole buffered ETF landscape was formed.
Yeah. How do they build a buffered ETF? Let's take the quant magic over, selecting which option at the strike price on, the day you put it together, just in a high form, right? Like what are the components of a buffered ETF? How does it deliver this outcome that's sort of predefined?
Yeah, it's actually a very simple option strategy. I know it sounds complex to be able to deliver something that has 100% downside protection and 7% upside exposure over a year. It sounds complex, but it's actually a very simple option strategy. And there's really 3 different legs of the trade that we will implement. So the first is we have to get the upside exposure. So to do that, what we'll do is we'll buy on the reference asset, so say the S&P 500 ETF, we will go and buy a deep in the money call to give us that 1-to-1 upside exposure. That gives us that's how we get the upside. Then we have to get the protection in place, and very simply, what we're doing there is we're buying a put and we're selling a put. So we're buying an at the money put, meaning that if the market goes down anything from where we're at, we're going to be protected. And then we are going out and selling a put where the protection ends. So, in the example of, say, a 15% buffer, we're buying an at the money put and we're selling a 15% out of the money put. So that's like the zone, if you will, that we're going to be protected against those losses from that 0 to 15 level. Now, all of that has a cost to it, right? That downside protection is not free. And so how we fund that downside protection is we then go out and sell a call at the exact level necessary to offset the cost of the protection that we just purchased. Meaning, how much money did we just spend on those puts, that put spread? We're going to go and fund it with the exact level necessary. So we're going to sell at the highest possible level that we can to offset the cost of the protection. Now, that step right there, you have full transparency. That we're always achieving the highest cap possible. In the insurance world, those are where some of the gimmicks take place. Okay. Sometimes they'll sell that call at a lower level, meaning giving you a lower cap than you could have otherwise achieved to generate more fee on the strategy. Doesn't happen with the ETF. Doesn't happen with Innovators ETFs. At least we are selling that. It's a 0 cost option strategy. So that's really it. I mean, it's again, sounds complex. It's really a simple option strategy, but it's designed to simplify things for the investor. That they don't have to worry about putting each of those individual trades on, managing them. It's all done in the ETF. And by the way, it brings up an extra layer of tax efficiency doing it that way.
Yeah, I think that's an interesting component that I like that people really overlook is that annuities are tax deferred, and people will call them a tax shelter because of that, and to a certain extent they are. And again, have a use case. However, when you take the money out of the annuity, assuming it's not an IRA or qualified funds, it's just a taxable annuity. It's not the most efficient way of money coming out, the way it's taxed. You tax that ordinary income. With the ETFs, you have that 1 year outcome period, but you buy the fund. And at the end of that outcome period, under the hood, you guys at your trade desk will be implementing the trades, buying and selling the new options contracts to reset those target outcomes, right? As the prior outcome period expires. Just like in an insurance contract or in an annuity contract, you would go like into the next year and you could maybe change your indexing options or whatever it might be. You have that 1 year sort of, hey, over the next year, you have this outcome. The ETF works the same way. Except at the end of that year, you guys are doing it under the hood. And so as long as no one needs to sell for any personal reason or whatever, it just rolls into the new outcome period. They have the new protection, they get the new upside, and no taxable distribution. And I've heard people, in particular, other financial advisors that they just don't always understand the derivatives market. One of the things that they'll say is, well, when you get these ETFs, they have the it's just based on the index, and so there's no dividends, right? Like it's tax efficient because there's no dividends, but you're missing out on the dividend yield. So maybe one of the things that you could speak to is, how is the dividend play into this in terms of the capture, right? Kind of up and down on in the options pricing.
Yeah, it's a great question. And so the dividend is not paid out, but what that dividend is used, we get that dividend up front, and it's used to pay for the protection too. It's used to offset the cost of that protection that is put in place. So again, it does make the strategy more tax efficient. And you do have some people that argue, well, dividends are a big portion of returns over time. But think about it this way too. You look at the S&P 500. Say you got a 1.5% dividend yield on that strategy. If you have a 15% buffer, you use that to pay for a 15% buffer. You get one normal market correction, over the next year, 15 years, you're going to pay for that dividend in its entirety. Okay, over the next 10 years, you get 15% correction. You've just paid for that. So it's just a trade-off. You're not taking the dividend, but you're using that dividend to pay for the downside protection. You're hedging against those losses. So it's not foregone. It's just used to pay for protection. And it's not being kicked out. So it's not a taxable event. And with these, never would we anticipate any distributions that are being made. When unlike the annuity world, when that outcome period is over, like you said, Brendan, it simply rolls over. It's underneath the hood. That is not a taxable event. All that happens at the end of an outcome period is you'll receive a new buffer and a new cap. You want to defer those for 10, 15 years, you're absolutely able to do that. We would never anticipate any distributions being made.
Well, and then, so now as the investor, you can choose when you want to sell it. And if it's been more than a year, you likely are getting more favorable long-term capital gains rates on that, which some people is as low as 0%, right? Federal. And can be obviously more substantial and higher depending on where your income's at. But highly, highly tax efficient. And so if you're that really tax sensitive person, but you don't feel, comfortable being fully exposed to the equity markets, you have to start looking for these other, options and opportunities, because, even though bonds are lower risk, right, it's got the tax problem. It doesn't solve the tax problem. It sort of can make it worse. Interesting. What I was highlighting with the dividends was that and correct me if I'm wrong, but essentially when you go buy long dated options contracts, the estimated dividend yield is sort of baked into the options pricing already.
That's exactly right.
And so you end up with a tracking error, which is just, hey, at the time the options were bought, they were expecting the S&P over the next year to do a 1.5% dividend and it ended up doing a 1.55. You didn't get the extra 0.5. Or it could work in your favor the other way. Hey, things slowed down and they were expecting 1.5 and it did a 1.4 on the dividend. Well, you got the extra 0.1. So it becomes a small, tracking error to that though, but it largely captures it still. Yeah, actually, right?
It does. They don't fluctuate that much unless there's a big
pretty stable
recession where they have to pull back on the dividend or something like that. So, but there's not a lot of variability.
Yeah. So it's a simple. Well, there's a whole nother, thing about talking about derivatives, right? That's a whole nother conversation. But the trade itself is relatively simple. And the thing that I like about it the most is, again, it's transparent. So there's not an opportunity for an ETF provider like yourselves putting the trade on to go to the markets and say, hey, we're going to buy it for, A, but we're going to only give our investors B and we'll make the spread. You guys as the fund manager, you put on trade A, you get A, it goes right to the investors and you guys get your management fee for managing the fund. But it's really transparent, right? And so if the market is giving you better pricing on the options, then the investors directly benefit immediately. Whereas an insurance company, you're typically going to be investing in any kind of like fixed insurance. So where this risk management stuff is most prevalent, right? In the index universal life or the fixed index annuities. You're investing actually in the general account of the insurance company and they're choosing, right? They're coming up with the terms. Hey, we'll give you a 7% upside capture. Well, they just structure the trade and maybe they got a 9 or a 10% upside capture, but that spread, they get to keep it for themselves because they're not, there's no contractual obligation there. They're giving you their terms and crediting you based on their terms, not based on what they're willing or able to produce themselves on the trades, right? And that's where I think the transparency is really beneficial for investors over the long term. And you can just, it makes such a big difference. Particularly, I think like when you talk about real rates of returns, right? When you're doing when you're talking strategy, right? You're helping people design those portfolios. Do you ever take into account like real rate of return?
Oh, definitely. And I think, real rate of return, we take into account the after-tax return. I think that's a big one. When you look at going back to the tax conversation for a minute, you look at what investors would have been allocated to otherwise. A lot of times it's not just a swap for a stock allocation to own a buffered ETF. It's a swap for a bond allocation. It's a response for a cash allocation. So there's a big difference. There's a big difference in the way those are taxed. When you look at the cash allocation, the bond allocation being taxed at ordinary income, that's a big deal when you can have the buffer ETF that can deliver the same risk profile to you, be tied to the upside of the equity market, and then come away with long-term capital gains, and also put yourself in control of when you're actually paying that tax bill. Yeah, it's a very big advantage.
Yeah, I think to that point, I caught some flack on Twitter recently. Somebody was sort of challenging this idea that these products are inherently bad for investors and they should just be invested in the index or, a balanced portfolio, well diversified, whatever it might be. And my kind of counterpoint was where I have seen these work really good is actually in helping clients overcome the behavioral biases that they have actually, right? So yeah, in a perfect world, none of us have any behavioral biases and shortcomings, and we all are Warren Buffett, right? Like we all make completely logical decisions. We can sit and say this investment hasn't made us money for 5 years, but our model's solid and all our returns going to come in year 6 and we're confident and we're fine. No worries. Problem is that we're not that. And in particular, like most retail investors and investors that are just trying to save for retirement and, manage to put together their own kind of personal finances that way, they have a lot of behavioral biases. It's natural and it's okay. It's part of the human condition, right? But if you're looking at it and saying, well, I don't feel comfortable in the stock market because I don't want to see a big loss. I'm really nervous about that. And so I put my money in high yield savings, right? It's in cash, or it's in, I'm buying CDs that are 6 months and they're making, 3, 4%. And that's all because they just feel nervous. They can't emotionally overcome doing the stock market thing. Right. And I think something like this gives them the ability to say, okay, well, hey, look, what could you do on the downside? And this is sort of the way I typically approach it. And they say, well, maybe 10% down. I could handle 10% down if that really was it. Well, if I look at something like a moderate buffer that's going to give them 15% downside protection, you can come back and say, look, pretty good bear markets tend to look like 25% down in the market. Well, now with a 15% downside buffer, it's looking more like 10. And that is not going to blow up your financial plan. And you could be okay. Right. And quite frankly, now you're rolling forward into the next outcome period with like essentially dry powder. So it should look really good, going forward if you stay the course. But it's bearable, right? And it's more emotionally okay. And what I've seen is then people get a rate that's now tied to equities. And so even if they don't capture the full upside of the equity market, it's their benchmark is now really not the S&P 500. Their benchmark is more cash, and cash alternatives, those low risk alternatives. And you can get people involved and help them do that. And I have seen that done. I've seen that be done to great success to people that have now gotten returns that they would have never thought they could have gotten because they were never really comfortable with the stock market in sort of its raw, unprotected form. Right. But they were okay with a buffered ETF that kind of defined where the outcomes were going to be. But also maybe they had their life circumstances demanded that they had some more liquidity than getting an annuity and signing a 10-year contract. Right. So that's where I think that these things start to have some play. Is it a perfect product? No, nothing is. There's no free lunches in finance. Right. In a perfect world, I have, like all of the money and I don't even need to pay an expense ratio to buy the S&P 500 index fund. 3 bips is too much. I could have none, but then where's the time decay in managing that? Right.
Yeah.
There is no free lunches ever. And nothing's a perfect product. So have you seen this as in your roles as chief investment strategist, working with so many advisors, has it been more of a behavioral hurdle, right? Helping people overcome behavioral tendencies, or is it really driving that, increased total return versus alternative investments?
I think it's both. I definitely think it's both. And I think what's interesting, if you look at, some of the recent critics, they tend to be rooted in theory and don't really understand how clients behave, how they think.
Mm-hmm.
And they're also have their own active strategies that have been underperforming the S&P 500 for decades. So yes, if you want to outperform over the long run, you have a 30-year time horizon, go buy the S&P 500, hold it, don't look at it. And you'll probably be in very good shape.
Mm-hmm.
But what these strategies really allow you to do is to control your risk. And so I think there's a couple things. Yes, there's the individuals that they're worried about the market, and they do have these behavioral biases. And I think what's so interesting, Brendan, if you look at when the market sells off, we start entering a bear market. Even the last week when we had that the 10% correction,
Mm-hmm.
investors
Mm-hmm.
start gravitating toward bonds and cash. They sell their equities at the exact wrong time, and they're losing returns. So what these strategies allow you to do is weather that storm, remain invested, and really stick to those goals. And you look at the practical side of things, the market can have significant sell-offs. It doesn't always go up over different time periods, and investors have different goals, whether
Mm-hmm.
they're in retirement, nearing retirement, or they just have different objectives where they might need money in the next year, 3 years, 5 years. Well, you can't always stomach with those dollars the full volatility of the equity market. You have to keep some of those dollars more secure. And historically, what clients will do is they'll take a portion of their assets, they'll bucket them, if you will, and they'll say, okay, here's my safe money, here's my savings accounts, my CDs, my money markets, my insurance products, my bonds. And the reality of it is, with the buffered strategies, what you're able to do is still maintain that low risk profile. But you're taking those assets that would have been allocated to those instruments that don't have upside. They have that yield. They don't have the upside of the equity market. We're tying them to the upside of the equity market via the buffered ETF, and we're able to increase overall returns. And by the way, we're doing it in a more tax efficient manner than having to pay ordinary income every time my savings account spits out a monthly distribution. So there's many different ways. And I would also say, the performance is there. I mean, we as you know, we run several different model portfolios of these in house, where relative to their peers, number one rated strategy across the board for risk adjusted returns. So there's a lot of substance behind it, but I do think it helps manage the behavioral element of things. Yeah. It helps increase tax efficiency. It helps increase overall return expectations on those safer dollars. So you're right, not a perfect product, but there is a lot of advantages for investors.
Yeah, I think it's something that people should definitely be considering talking about with your advisor if you're, in particular, low risk and tax sensitive, right? Or maybe not low risk, but you're more conservative. You're interested in being more conservative maybe, but you're really tax sensitive. And that's where I think like that it seems to have the best place in that home, right? There's obviously some different ways to implement them across a more globalized portfolio, or kind of working in tandem with other assets. And that's a conversation. If you're one of our clients, reach out. We're happy to have the conversation with you. If you're not, have it with your advisor. If your advisor thinks that these kind of things are useless or meaningless, maybe it's time to get a second opinion. Feel free to reach out to us. But there's, again, tax efficiency. There's some risk management. There's the upside capture over time. Not 100%, but relatively okay. It's decent trade-off, and you're not having to try to time things the right way or make sure you're picking the right stock or that sort of thing. So it limits some of that variable risk there. I'm trying to think what like the really good way to explain that would be. But
Brandon, maybe one point while you're thinking of that too, I think to your point on the second opinion, I think it's critical, especially now. You talk about a lot of the insurance gimmicks earlier. There are a lot of different firms out there that do not allow their advisors to use these products. And I think a big reason for that is they're heavy sellers. Their firm is a heavy seller of creator of the index annuities. So for a lot of major wirehouse firms, they have not approved these strategies. They cite complexity. But I think a big reason for that is they have these big structured note desks in house that they're making a lot of money off of. So to be able to go to the buffered ETF, which you guys offer, and take fees down to a fraction of what they were, they don't like that. So I do think the second opinion is incredibly worth it, especially if you're using any annuities, insurance products. Take a look, see what's under the hood, and see what you're actually paying for those and what you could be achieving in the transparent wrapper of the ETF.
Yeah, I think touching on structured notes was an interesting call out too. I think that's probably a whole nother episode on how those work, and those certainly are complex, and they get more complex the more you talk about them. But yeah, that's if you're using structured notes a lot, there might be some other opportunity to think about things a little bit differently and have a little bit more liquidity and transparency. Again, not a perfect tool, not always the best fit. Certainly there is areas where it doesn't work well. And I think there is opportunity for other investments, right, to be considered. And it still has a different profile, right? I mean, like one of the risks you run with a buffered ETF is if the market returns zero, you get zero, right? If interest rates don't go anywhere and you had a 10-year treasury at 4.5%, you still made 4.5%, right? So it's not a perfect, plug and play, just purely better in every scenario alternative. There's just an opportunity for a good use case. And that use case is largely in the place where other things have been a bit more abusive in the industry. So anyways, some good things to consider. Tim, any final insights you want to provide with people where you're seeing the markets right now, what people should be considering or thinking about, anything like that?
Well, I think it's all the questions we're getting now, Brendan, are on tariffs, and I think the tariffs probably couldn't provide a better backdrop for a lot of the defined outcome buffered ETFs because they're what I would consider to be the ultimate source of uncertainty. What we have our models, we predict where we think markets are going, and I almost would equate the tariff piece to almost like a COVID situation where your traditional economic models, your predictions of where things could be heading, you can throw them out the window because we ultimately don't know. I mean, at the end of the day, the impact on the markets could be very minimal, or it could be catastrophic, depending on how the Trump administration ends up implementing, depending on how far this tit for tat goes. It's very clear that President Trump wants to use these tariffs as a negotiating tactic. So how long is it going to take? How far is he going to have to push to get what he wants? We don't know. So it's a source of uncertainty. I do think we are going to be in this situation where you are going to see continued volatility in the short term until we get more clarity. I think this April 2nd date is going to be very important, figuring out what those tariffs actually look like. So I think the bottom line at the end of the day, it's really important. We have to keep our foot on the gas pedal. Trump could take these off at any point in time, but ultimately it's really about how do we prepare our portfolios and our investments for a wide range of outcomes. You can't predict where things are going when we don't know the impact of what these tariffs will look like.
Yeah. You can't ever guess the future, and risk is the presence of there being an outcome other than intended. So you always have, I tell people this, you always have the net the same amount of risk because it's like energy. It can't be created or destroyed. It can just be converted. So again, this isn't, just to highlight, buffered ETFs are an interesting idea. They have a use case, and although tariffs cause uncertainty, a risk of not being invested could be the risk of missing out on great returns, right?
Absolutely.
The risk of being invested could be not getting any returns. I don't know, and I don't know what's going to happen in the next year, right? I have a forecast. I have an idea. I've got different ways to express different trades and be nimble around it. But as a market technician, right? Like I trade the screens in front of me. So for me, come what may, and we'll love it either way. We'll figure it out. But I think for again, people looking for some different alternatives that are not as risky, pick up the tax efficiency, and kind of be able to deal behaviorally a little bit better with some of the tariff talk. It's an interesting idea. So, Tim, I appreciate your time. Thanks for hopping on. I think it's going to be a great resource to have clients and people interested in working with us listen through what is this buffered ETF stuff. So
it's great. Yeah. Thanks so much for having me, Brandon.